I'll start with you. Some of your thoughts on these tech names. I know you own a name like NVIDIA, I believe, for example, but do you like the group overall?
Well, Nicole, I think what's interesting in the Mag 7 is that there is a bifurcation between business models. So while during the prior tech cycle, you could really buy any of them and do well, right now, each one has its own story. So if you look at it, we really focus on returns on invested capital. So NVIDIA screens particularly well because they really don't need to invest a ton of money and they're printing money on the other side. Some of the other ones like Amazon and Microsoft, they need to invest significant amount of capital to be able to keep up the momentum on the earnings side. And then Tesla, Apple, all of those could be very interesting, but there's still a little bit of show me stories here in terms of how they position themselves for AI and whether, for Tesla specifically, it will gain broader regulatory support.
Yeah, and we saw Apple last week running as Tim Cook has been working with the president. What is your big picture here, Austin, as you take a look here in some of the themes, because you want to really focus on the monetization of AI? I mean, the feeling really is that Microsoft has been doing that. You tell me, is that right?
Yeah, definitely. CIOs are reporting productivity gains, and so we're seeing the inference era happen. And how are companies monetizing that? Well, for Google and Meta, it's really about just monetizing their core advertising business. And then downstream for players like Microsoft and Amazon, it's from a cloud provider perspective, being able to go to industry and rent them GPUs. Now, to Ivana's point, now we're starting to see this bifurcation of stories. So for example, Microsoft Azure is doing well, Google Cloud is doing well, Amazon's AWS is falling behind with the Gen AI. They don't have enough GPUs, they don't have enough power. And so there's still opportunities here, but it's not as simple as just invest in anyone and it pays off.
Yeah, you said Amazon and Tesla are facing some challenges. I mean, you had sort of the Tesla Apple show me story that Amazon needs to spend in order to do well. You had some names that you did like, Ivana, that I was interested in to hear. Astera, Arista Networks were in there, NVIDIA, which we mentioned too.
That's right. So we really like investing across the value chain, and specifically for data centers, we think there is going to be a new wave of investments coming. So the prior generation of NVIDIA chips was going into existing infrastructure. The next generation, the Blackwell system, will be all new infrastructure. So this is where you really want to be invested in networking, you want to be invested in power generation, just broadening out from just few stocks, right, to where the real alpha is going to be generated.
Yeah, understood.
Earlier this year, NVIDIA's stock saw a sharp decline due to concerns about Chinese competition and tariffs. Growing infrastructure expenditures by its biggest clients indicate that demand for artificial intelligence, AI, is still high. The share price may not yet completely represent emerging AI potential, despite a robust recovery over the past few months, according to valuation trends. For NVIDIA's shareholders, this year has been an emotional roller coaster. The company's shares fell as much as 30% earlier this year, with the announcement of higher tariffs and increased competition in China, wiping off around $1 trillion in market value. Although such sharp drops would have implied that NVIDIA's heyday was over, the stock's more recent performance contradicts this. It is now the most valuable firm in the world, with a market valuation of $4.4 trillion as of August 7, having recovered 93% from its 2025 lows. Is it too late to invest in NVIDIA now that the stock is reaching all-time highs due to such tremendous momentum? Let's investigate. The computer and networking division of NVIDIA is the company's biggest income generator. This category includes the company's highly sought-after graphics processing units, GPUs, and data center services. Spending on artificial intelligence, AI, is a good indicator of the company's health. Capital expenditures for cloud hyperscalers. Amazon, Microsoft, and Alphabet, as well as social networking startup Meta platforms, during the past 3 years are depicted in the chart below. These magnificent 7 businesses demonstrate how NVIDIA's semiconductor company might benefit greatly from rising investments in AI infrastructure. The growing use of cloud infrastructure services from Oracle and neocloud platforms like Nebius Group and CoreWeave, in addition to the typical suspects of tech giants, provides another source of demand for GPUs, particularly for NVIDIA's most recent Blackwell architecture. Neoclouds are becoming more and more popular right now because they provide cloud-based infrastructures for access to GPU clusters and adaptable software-hardware stacks in the form of high-performance computing, HPC services. Investors have heard analysts talk about the significance of data centers in advancing the development of generative AI on numerous occasions in recent years. This is true, but I believe that many investors are failing to see the bigger picture in terms of how AI infrastructure spending has changed over time. Advanced workloads in robotics, autonomous driving, and quantum computing are part of a new stage of AI usage. While Amazon, Microsoft, and Alphabet are all creating their own unique quantum computing processors, companies like Tesla and Alphabet are starting to make money off of their driverless cars. NVIDIA is only now beginning to expand its CUDA software platform and hardware to take advantage of these new prospects. I'm confident that the company's product suite will continue to play a significant role in the creation of more sophisticated AI in the future, especially given its current strong integration with big tech. The company's forward price-to-earnings (PE) multiple during the AI revolution is depicted in the chart below. The forward PE range of 24 to 30 might be viewed as a support zone or valuation floor for NVIDIA given the previously mentioned patterns. The stock has always recovered well after its forward PE fell into this region. This implies, in my opinion, that despite sporadic, brief episodes of negative mood, investors continue to envision strong long-term growth for the business. These patterns in valuation, in my opinion, suggest that the market may be underestimating the extent of NVIDIA's pervasive platform. Many investors still only see the company as a semiconductor company, even if it has a significant impact on AI infrastructure. I believe the stock is poised for a sustained breakout when these new opportunities materialize, akin to the initial surge of AI-driven excitement a few years ago. I believe there is a strong argument to be made that the company is positioned for future valuation expansion and might reach or surpass historical levels, even though its forward PE is rapidly approaching previous highs. According to my reasoning, investors have not yet properly priced into the stock the monetization potential of upcoming prospects in robots, driverless vehicles, and quantum computing. The stock may surge beyond $200 and approach $220 by the end of the year if NVIDIA's current future PE grows to levels consistent with previous highs, which would indicate a 10%-20% gain over current price levels. Because of this, I believe that by the end of the year, NVIDIA's stock will be trading much higher than it is now. So, what implications does this have for NVIDIA's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on NVIDIA stock in the comments. Your support truly helps us grow. Now, let's get back to the video. NVIDIA's explosive growth is a market story as well as a stock story. Because of its size, NVIDIA can significantly increase the S&P 500 or the NASDAQ composite on its own. Gaining close to $500 billion in market value is like constructing a firm the size of Netflix out of thin air, which is saying something, since Netflix is the 16th largest S&P 500 component by market cap. Wider market gains follow NVIDIA and its mega-cap counterparts. Here's why I firmly believe the market valuation of the growth stock will exceed $5 trillion, and why NVIDIA has a well-defined path to success in the future. NVIDIA's market worth was less than $500 billion 3 years ago. To become the most valuable business in the world, NVIDIA had to rise above $4 trillion in market capitalization through a combination of investor optimism, profit growth, and the emergence of a new era in artificial intelligence (AI). However, NVIDIA will have an easier time getting to $5 trillion and beyond. While there is just a 25% rise from $4 trillion to $5 trillion, there is an eightfold gain from $0.5 trillion to $4 trillion. On a percentage level, it's not asking for much over a few years, but it's an unparalleled amount of value creation. Investors might be less inclined to pay such a high price for the stock, though, if NVIDIA's earnings growth rate slows. At 58, NVIDIA's price-to-earnings ratio is significantly higher than that of the majority of its mega-cap competitors. However, NVIDIA can support that price since its earnings are expanding at a far higher rate. However, if NVIDIA were to slow down to levels of a company like Microsoft, which has achieved 15% revenue growth over the last few years, with net profit margins around 36%, then NVIDIA's valuation could compress. Even if the stock's PE declines and its profits growth rate slows, it may still be a great investment and continue to reach market cap milestones. The more important question, though, is where the money will come from. The fact that NVIDIA's clients include some of the top businesses in the world is arguably the most straightforward explanation for the company's sustained growth over time. NVIDIA usually includes a section titled Concentration of Revenue in its quarterly 10Q filings. Sales to one direct client, Client A, were for 16% of overall revenue for the quarter, according to NVIDIA's most recent 10Q dated May, the first quarter of its fiscal 2026. Sales to a fourth direct customer were 11%, sales to customer B were 14%, and sales to a third direct customer were 13%. NVIDIA's compute and networking segment, which mainly consists of high-performance graphics processing units, GPUs, for data centers and related hardware and software to manage AI workloads, such as devices that link GPUs together and facilitate system communication, was responsible for the revenue generated by all four customers. These clients collectively accounted for an astounding 54% of total quarterly revenue. Although NVIDIA does not specifically identify these clients, it is quite probable that they are Amazon, Microsoft, Alphabet, and Meta platforms, all of which rely on NVIDIA processors to run their AI infrastructure, services, and data centers. Aside from these big four, several other businesses like Oracle through Oracle Cloud Infrastructure are quickly pursuing cloud and AI goals. Tesla uses NVIDIA's GPUs in its autonomous driving models, making it a major customer. Through the Microsoft Azure OpenAI service, a platform for utilizing and creating OpenAI models, OpenAI is also a significant indirect customer of NVIDIA. Revenue concentration is typically a warning sign since it indicates that one or two clients could negatively impact outcomes if they reduce their expenditure. However, it may work to NVIDIA's advantage because its best clients have outstanding balance sheets, rising profits, and plenty of free cash flow. To put it another way, they have the means and avenues for innovation to gradually increase their expenditures over time, which will help NVIDIA's profits rise. Now that it is around the $4.5 trillion mark, NVIDIA's path to $5 trillion in market capitalization will be simpler on a percentage basis. NVIDIA's top clients must, however, receive a respectable return on their investments if the company is to remain a profitable stock. To put it another way, NVIDIA needs to be at the forefront of the AI market's growth from a computing and networking perspective. As a result, investors in NVIDIA might want to think about making the connections by listening to what its major clients have to say in their quarterly results and investor presentations. NVIDIA stands to gain if they maintain their enthusiasm for AI and keep increasing their funding for it. However, if the spending cycle shifts from expansion to downturn, NVIDIA's stock price and earnings could suffer significantly. Analysts at Macquarie say Beijing's long-term artificial intelligence policy is unlikely to change if NVIDIA's H20 AI chip shipments to China resume. The action is still controversial, even though Macquarie stated that it marks a turning point in U.S.-China trade talks. According to the analysts, U.S. lawmakers and political organizations are unhappy that the Trump administration is sacrificing national security for financial gain, while Chinese regulators seem to be resisting the use of H20. According to Macquarie, the H20 is more of a short-term fix for China to meet the need for AI inference. The long-term objective is still to develop an end-to-end AI ecosystem domestically. According to Macquarie, recent announcements demonstrate a fundamentally different strategy between the two nations for assuming leadership in global AI. The U.S. strategy is inward-looking and focuses on exporting full-stack AI solutions that are centered in the United States while also developing domestic infrastructure. China's plan, on the other hand, focuses on cross-border open-source development and adopts a multilateral strategy to assist emerging markets in closing the digital divide. Despite having access to NVIDIA processors, Macquarie predicted that China will likely keep making significant expenditures in its cutting-edge semiconductor ecosystem. With solar companies that have no bearing on the rise of AI, the MSCI China Semiconductors Ahead PEE of 65x trades at a more than 2.5x premium to the SOX index. Rather than conventional manufacturing or packaging, Macquarie believes that optical components like InnoLight and IC design like Cambricon have the highest AI beta. The analysts consider internet data center proxies like Alibaba to be attractive in terms of quality and risk-reward among more general investments. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
Normally, when the government gets involved with business, you expect it's going to be bad, or at least bad for the business in question. In this country, we like private industry to stay private, and we want its interactions with the federal government to be as minimal as possible, unless the company needs a bailout. Otherwise, just forget it. But that's not the way of this government. Certainly not when it comes to NVIDIA or AMD, as we learned today, which had Wall Street buzzing on an otherwise mixed session. Dow slipping 201 points, S&P declining 0.25%, NASDAQ edging down 0.3%. This morning, we learned that the U.S. government is planning to take a 15% cut on all the AI chips that these two companies are currently selling to China. For NVIDIA, that means a 15% cut on the H20, which was their cutting-edge chip for AI a few years ago, something they were previously banned from selling in the PRC. The president then said that NVIDIA might be getting approval to sell a next-generation chip to the Chinese, something, wow, more like their current version, Blackwell, except it won't have as much computing power. We didn't expect that Blackwell could be allowed in China. This was a big deal that the market completely just ignored. That was a mistake. The president had asked for a 20% cut of revenues, but NVIDIA CEO Jensen Huang bargained him down to 15%. That was good. The news was greeted as a total novelty, although it wasn't the first time this government has taken a stake to profit from its own moves. Not that long ago, the Defense Department took a 15% stake in MP Materials, the rare earth mineral company with a stock that subsequently doubled. Good trade for the country. We need these materials for national security, and an even better trade for the Defense Department, given that it caught a double. The cost to shareholders for the NVIDIA deal, as we told Investing Club members today, NVIDIA was selling about $8 billion worth of chips to China, that's every quarter, prior to the previous export restriction. A 15% haircut would equate to a little more than $1 billion per quarter, or about $5 billion per year. Hey, that's a big number for most companies, but not for NVIDIA. They were desperate to get this China business back by any means necessary. If the choice is between not having it or paying Uncle Sam a 15% cut, they're going to pay 15% every time.